Transitory, that was meant to be a 2021 word. If you do see inflation falling next year, what are the implications for rates?
Yeah, one of the things that are very interesting when we get the 6.8% CPI, what has happened is, for example, 10-year tips break-evens, Bitcoin or some sector stocks and even some commodities, these so-called inflation hedges have all fallen. What inflation does, unusually high inflation does, is it reduces longer-term growth and inflation expectations. And so at the moment, the Fed is in a very tough place because it needs to sound hawkish to remain credible. But then if it sounds very credible, then it is likely to bring down longer-term growth expectations. So that's not desirable either. And so I think by, say, the second half of next year, we'll be much less concerned about inflation and also probably less concerned about policy because we're likely to see the supply chain to recover as well, and that's really what's driving up inflation at the moment. And so this is definitely lasting longer than a year, this inflation scare. So you can't really call it transitory, I suppose, right. But I think it will still come down next year.
Well, in the meantime, we do have 20 central bank meetings this week, and monetary policy divergence is happening here. So we'll see the Fed potentially tightening down the track, China potentially easing. From an investment perspective, which of these two narratives are the more compelling when you're looking at putting money to work?
I think the China story is becoming relatively more compelling. It's obviously had a harrowing year because of very politically driven tightening in all sorts of policies. And so I mean, today we're still suffering from the real estate part of that policy tightening. Right, so I think we'll probably continue to see more negative headlines from that aspect for a little while. But I think last week's Central Economic Work Conference has sent a very clear message. Officials at all regions and departments need to get things rolling, get growth supportive policies rolling relatively early. And I think that's the message being sent down from the central government. Compare that with what the Fed needs to do to gain credibility. I think China does become more resilient to what the global market might feel from Fed action.
How bullish is it for stocks, the message that we heard from Chinese authorities in the past week? We have seen this GTV chart on the Bloomberg already showing that the CSI 300 has broken out of its recent range, really soaring upwards.
Yes, I think that's a clear sign that the market is moving in towards that message. It's also happening when the rest of the world valuations is very different. Very much higher, and so I think this could last for a while longer. It is about restoring confidence in earnings growth. It is about getting earnings revisions back into the positive territory, which I think will happen in the first half of next year. So I think this is a pretty stark contrast in terms of policy and growth trajectory. Right? Remember, China's 4Q growth is going to be miserable. Probably have a 3 handle. So if we're going to make this 5% target that we expect the government will set, then they need to do a lot more.
What does that mean for other assets? Because we have seen the Chinese yuan pretty strong, right? So if we do see more support, especially coming from the fiscal side of things, more than monetary easing, what does that spell for the currency?
So I think the currency largely will stay in range. Probably looking at a 3% range, but we're on the strong side of that range. So what's going to happen? We've already seen the positive carry that the CNY has over the dollar narrow to a point that makes the current exchange rate seem overvalued. Yeah. So I think when we have some policy easing coming out of China. Even if that comes with better economic news, we might see the renminbi weaken. And also the PBOC, central bank in China, has clearly signaled that they want to reduce the one-side bets for CNY strength. And I think that's also going to affect the Chinese currency a bit. So weaker Chinese currency might be a bit better for the efforts to bring in stronger growth next year.